Hello everyone, welcome to our discussion having to do with self-employed business income and the Schedule C. As we move on from our first exam, we're looking at some things that come up quite often when you are preparing tax returns for individuals, and that's those who feel like or have a business, or at least one that they look at as a business, especially in today's world where there's so many people working on some kind of side hustle, whether that be driving for Uber or some other thing. So there's some really important principles that we need to look at. So this is part one, and we'll look at the introduction here. So when we're talking about trade or business, this is the definition in the law, is that it's an activity that's engaged in for profit. That's in contrast to one that is a hobby where you don't intend to make money. Now, it used to be that hobby losses or expenses in hobbies could still be utilized to offset the income, but that is no longer the case in the new tax law. All right, so the definition between the two, between being a business and a hobby, is really important. If it's a hobby, the income is reportable, but not the expenses are not deductible. If it's a business, then the income and the expenses, and in fact, you can have a loss, you can have more expenses than income and use that loss to offset other income. Now that becomes very important. If that's the case, if there are more expenses, you are going to know that the IRS is going to look at that very carefully to see if it really is a business, and you're not just trying to deduct expenses for your fun hobby like water skiing or something like that. So you'll have an opportunity to look at that in more detail and what that requires. We'll have a later slide about it as well, but you'll also have a discussion question about how the IRS looks at that and how the tax court has interpreted that law. This income is reported on a Schedule C. So that is a supplement to the 1040 where you calculate, it looks like a net income statement, and you take that income from that business and it flows to the form 1040 and gets added into your income there, and so forth. So that's we had our Schedule A for itemized deductions. Now we're in Schedule B for interest and dividends. Now we're at Schedule C for business income. So where does it come from? Where's the revenue on that come from? You can sell stuff to customers just like any business. Often we refer to, especially as independent contractors or statutory employees. Now, a statutory employee, don't let that trip you up, is not treated like an employee. It is someone who is an independent contractor, but yet has qualified to have some of the taxes withheld from their check. So in that regard, they're treated a little bit like an employee. Now, Form 1099 MISC is what the employee or the payer sends to the independent contractor. So if you are looking at doing a tax return for someone and they've received that as that 1099 miscellaneous, you need to know about that so that you make sure that you have revenue that is at least the amount of the 1099s that are reported, because the IRS is going to match that up. The difference between an employee and a independent contractor is a little beyond this course, but it is an important issue in the real world. Generally, the idea is who is in control of when and how things are done. If the employer is, then you're probably an employee. If you are, you may be an independent contractor. But that's a simplified way of looking at that. But that's an important consideration. but assuming that that is clear and you're an independent contractor, then it can be, then it could be reported on Schedule C. Take off cost of goods sold. Typically, you're going to need to use accrual method of accounting if you have inventory. However, if you are not that big, you don't have that much money, you still use cash basis for anything other than the inventory itself. You cannot use the cash basis for the inventory itself. So what you end up using is what's called a hybrid method, where you use accrual accounting for inventory and cost of goods sold, and cash for accounting for everything else. And that's by far and away the most common thing, way that a company with actual inventory and cost of goods sold does it. All right, so we get to the idea of what is expenses. And of course, there's lots written about it. Lots of people request to say, okay, is this a deduction? Can I take this on a business expense? There are books that are written that say if you start your own business, then you can deduct these things. But the rules don't try to say all the things that are deductible. However, the general idea is it is not deductible unless specifically mentioned in some way or another. Now, the very broad way that it's mentioned is it has to be ordinary, means the usual things, necessary, reasonable. Ordinary means it's not a big amount that is going to last for a long time. So if you buy a building, that may be necessary and reasonable, but it's not ordinary because it is going to be a capital cost, and it's going to be used over a long period of time. So you're not going to have to do it. You wouldn't buy a building every year, okay? Necessary, it doesn't have to be essential. You can't not have to be, companies can go out of business if it doesn't buy this, but it can be just appropriate and helpful. And then reasonable means it can't be way over how much you would normally spend, and so forth. So you can't be luxurious or extravagant is the kind of terminology they like to use. Some things are never deductible. All right, so we have some rules that say anything to do with that's illegal. Okay, lobbying, political expenses are never deductible. Fines, penalties, parking tickets, all of those things are not deductible. Anything you pay because you did something wrong is not deductible, which is kind of interesting because illegal income is included. You have to report that, but you can't take any deductions for that illegal income because they're illegal things. And so you end up with a big tax liability if you do something illegal, and that's tripped up more than one criminal who actually didn't get caught for what they did, but did got caught for not paying their taxes on the illegal income. That also has some issues with and is being worked out in courts and other things with having to do with marijuana or cannabis use and how much is, what is illegal or legal depending on what state and under federal law, because this is federal law we're talking about here, and yet illegality or legality of marijuana is on a state law basis. So it can get a little tricky on some things. All right, probably one of the biggest concerns with regard to our expenses is the calculation of depreciation. You've dealt with depreciation in an earlier accounting class. You generally looked at it from a straight line basis. You learned that you depreciate things that are going to last more than 1 year, and so forth. There was a lot of judgment in the accounting rules with regard to depreciation. However, under the IRS guidelines, they tried to take a lot of the guesswork, a lot of the judgment out. And so you basically need to know the basis, what you paid for it, the depreciation periods, and they've limited the ones that you're going to use for the most part. They've given us a couple of conventions. You may have talked about the half-year convention in the regular accounting, but we have half year, mid-quarter, and mid-month, and that refers to the first and last year of any depreciation life. So that only applies in the first and last year. Either you take a half year in the first year and a half year in the last year, or you take it based on how many quarters or how many months. Okay, we'll see how each of those applies here in a minute. Depreciation method, really it's only 200% declining balance in straight line. The 150 we're not going to see a whole lot. It's only used on a very few assets. Then we report this on the Schedule C. Schedule E, and we'll talk about rental activities later, that's where that is, and Form 2106, which is really not applicable anymore because it only varies for some very specific individuals who get to take some deductions that nobody else does that we're not going to spend a lot of time on. But how much you calculate depreciation becomes a deduction on those. However, the actual depreciation for any business gets reported on Form 4562 before it goes to any one of those schedules. So, where would you find the basis? What for your asset? Okay, that you know you need to depreciate, so I got to find my basis. You know that, well, most of the time it's your costs, including all the costs necessary to get it ready to use. So you look up how much it cost you when you bought it, include costs like sales taxes and other things that might go into getting it ready to use. However, there are some assets that you may not have bought. You didn't go to the store and buy, or didn't buy from another business. You actually converted. It was a personal use asset, and then you converted. Now, no depreciation on assets when it was personal use. You don't only get to depreciate assets when they are in use by the business. So what happens is you start depreciation at the point that you convert it from personal use to business use. Well, there's some rules about that because that could be subject to a lot of misuse. So the rule is your basis is the lesser of the fair market value or the cost. So it could be what you paid for it when you bought it, or it could be the fair market value when you convert it, which if that is less. Okay, that's the point. If it's less, then you use the fair market value. Okay? If it's a non-taxable exchange, then it's your cost less any deferred gain. We'll look at those kinds of exchanges in a little more detail later. Okay? But that depreciation will not be what you originally paid for it. And then if you inherit it, it is the fair market value at the date of death. Now, if you inherited a business property that you can depreciate, again, it's only for business or used for rental or something like that, that it'll be the fair market value at the date of the person who left it to you will be where you start depreciating and calculate your depreciation. Everything essentially that we're going to talk about falls into these 5 categories. And most of them are going to be really the 4, 5, 7, 27 and a half, 39. There's also a 10-year property and 15-year property, but they don't come up very often. But basically the IRS, and if you want, you can find they have taken every asset you can think of and they've plunked it into one of these things. So you don't have to know a whole bunch of calculations. You just need to know the calculations for these particular time periods. Okay, notice this is real property, residential, non-residential. These are non-real property or personal property. That is the term the tax law uses. Even though it's business use, it's still considered personal property to differentiate it from real property. Okay. All right. Back to our conventions, half year, mid-quarter, mid-month. All right, you always use the same in the year of disposal as the year you purchase. A half year convention means you assume a half year. in the year that you bought it and a half year in the year that you dispose of it. Mid-quarter, you assume that you bought it in the middle of the quarter that you bought it. So if you bought it anywhere between April 1st and June 30th, that second quarter, then you calculate depreciation as if it was bought in the middle of the quarter, May 15th. Okay? Mid-month convention. Everything you buy in the month is assumed to be bought in the middle of the month, the 15th of the month. So anything in February is assumed to have been purchased halfway through February, February 15th. Okay? That really is a way to make our lives simpler. It makes our calculations easier. We don't have to look at the number of days. We just need to know what month or what quarter or what year they were bought in, and we can just take half of one of those depending on what applies. This is the general for real estate, mid-month, personal, half year, except where you try to beat the system and buy too much of your assets at the end of the year, and then you have to use the mid-quarter convention. So that's when they come into play. So most of the time it's here, and this only in special cases when you bought too much assets. Over 40% of the assets you bought in the year were bought in the fourth quarter. Then the mid-quarter convention kicks in.